If you've been taking payments through Venmo, PayPal, Stripe, Etsy, or even Patreon, your business or side hustle just got a lot more visible to the IRS. In 2025, once your total payments received on a single platform exceed $2,500, that platform is required to send you a 1099-K and report it to the IRS. Whether you're running a small business or casually selling on the side, these new rules affect you, and not understanding them could cost you. Let's break down exactly what's changing, what you need to do about it, and how to avoid getting caught off guard. So, what is a 1099-K anyway? Also known as payment card and third party network transactions, it's a tax form used to report payments you've received through third party platforms like PayPal, Venmo, Square, or Etsy. If you're being paid for goods or services, these platforms are now required to report that income directly to the IRS. Even if you're not officially a business, the form still counts. And once the IRS sees it, they're expecting it to show up on your tax return. In the past, platforms only had to send a 1099-K if you made over $20,000 and had more than 200 transactions. In 2024, the IRS temporarily dropped that to $5,000. But in 2025, that threshold officially drops to $2,500, and that's based on gross payments before fees, not your net earnings. So even if you only take home $2,400 after processing fees, if your total payments received are over $2,500, the platform will issue a 1099-K. Any payments for goods or services count toward the threshold, but here's the key. The $2,500 threshold applies per platform. So if you earn $2,600 through Stripe, you'll get a 1099-K from Stripe. But if you earn $1,800 on Etsy and $1,500 through PayPal, you won't receive a form from either, even though your total income is higher. That's why it's so important to track your income by platform. Each one is reporting independently to the IRS. And with platforms like Venmo, it only applies to business accounts or transactions marked as goods and services. Personal transfers between friends and family aren't reported. Now, let's clear up a big myth. Getting a 1099-K does not mean you're automatically taxed on the entire amount. The form reports your gross income, meaning the total amount you were paid. It doesn't reflect your business expenses, like supplies or equipment. You still report that income on your tax return and then deduct your business expenses, usually on Schedule C. But if you ignore the form or underreport it, the IRS assumes the whole amount is taxable, and that can lead to problems. Who's affected by this? This affects a wide range of people, and not just full-time entrepreneurs. If you're a freelancer, an Etsy seller, a content creator, or even a casual side hustler flipping things on eBay, you could be getting a 1099-K in early 2026. Now, there's a bill in Congress that could roll this back to the old 20,000 rule, but it hasn't passed yet. Until that changes, we have to plan based on the law as it stands today. And even if Congress does pass a rollback, you'll want to stay updated because it could impact how you file next year. So, now's probably a good time to hit that subscribe button. I'll be covering all major IRS changes as they're finalized. Okay, let's talk about how you can prepare for this. Start by tracking your income and expenses consistently, either through a tool like QuickBooks, Xero, or even a well-organized spreadsheet. Make sure you're separating business and personal finances, and download all transaction histories from any platforms you use, especially if they'll be issuing 1099-Ks at year-end. To make this easier, I've created a free downloadable 1099-K income tracker you can grab using the link below. So, what happens if you ignore that 1099-K or forget to report it? The IRS uses computer systems to match your reported income with the forms they receive from payment platforms. If there's a mismatch, you'll likely get a CP 2000 notice, which is basically the IRS saying, hey, you forgot something, and now you might owe back taxes and penalties. It's much easier and cheaper to report it right the first time. There are a few exceptions, but they're trickier than people think. Personal payments, like your friend paying you back for concert tickets, aren't taxable. But if you use a business account or don't label it properly, the platform may report it anyway. Always use friends and family options when appropriate and clearly label personal transfers. And never try to disguise business income as personal. That can backfire fast. Let's wrap up with 3 key takeaways. First, review all the payment platforms you've used this year and see if you're close to the $2,500 threshold. Grab the free 1099K income tracker. I linked below if you need help with that. Second, start tracking that income and separating business expenses now, not when tax season is here. And third, be sure to subscribe so you don't miss updates, especially if Congress rolls back these reporting rules. Staying informed now could save you thousands later.